Hello, and welcome to the Investing on the Go podcast. I'm Chris Sarley, and today we're joined by Robert Burdett, one of the co-managers on the elite-rated BMO Navigator Distribution Fund. Thank you for joining us today, Rob.
Thank you for having me.
There's only one place to start, and that's with the repercussions of the pandemic on the portfolio. You were recently quoted as saying 25 years of experience could not have prepared you for the impact it had. Could you maybe talk us through the challenges for the portfolio and the outlook going forwards?
Yes, thank you. So if we go back to the beginning of the year, the coronavirus was quietly taking hold in China, and we were aware of this. We were looking at the issues, and it did appear at that time that they were controlling it in a similar way in Asia to SARS, bird flu, swine flu, and the previous worrisome flu-related illnesses. At the same time, the world economy was accelerating. As recently as the end of February, growth was up year on year. And this was sort of powered by the rate cuts in the US last year and stimulation of the Chinese economy. But markets had run ahead extremely strongly the previous year, 2019. So in that mix, we came into the crisis with a fairly conservatively positioned portfolio because of the high levels of markets. A little bit of concern about coronavirus, but it did look containable. Now, that containable aspect clearly looks wrong now, although even today, I think the deaths are at about a horrific 619,000 worldwide. That's still below a bad year for flu in the world. So we'll see how history looks back on this. But of course, what happened next was the global shutdown. And that is something that my 25 years definitely didn't prepare me for. There was the so-called Hong Kong flu outbreak in the late 60s, killed between 1.5 and 2 million people, and there was no economic shutdown. The NHS was fine. So everything pointed to not seeing that level of reaction, in our opinion. But of course, there was a sort of a Mexican wave effect of governments copying each other on shutdowns. And that is what has killed the markets in March. And in addition, obviously, you had state intervention on dividend policy. You had collapsing interest rates from already record low levels. And these were things that challenged a lot of areas of the investment world. So, yeah, it was a difficult time.
Obviously, we've had a bit of a recovery since then. You've actually recently moved underweight equities in the portfolio. Could you maybe explain why and how that's working out?
Yeah, so we're thinking of the world at the moment in two roadmaps. The long-term roadmap is where the second order sort of economic effects take hold. And what do I mean by that? I mean, jobs get cut permanently, companies close down, furloughs end, and the world is a more difficult place with lower economic growth. And that is not great for most asset classes. So that is the sort of behind our strategic underweight in equities, if you like. More short term, there is the positives are sort of more sentiment driven. So it's state support for furloughing, for investment, pay rises, as we saw yesterday, for key workers in the NHS and so on, possible virus vaccine developments. And generally, bear markets do have a sort of a relief rally after the first strong fall. And this time we have not only monetary support, so interest rate cuts, but also we have tax breaks and an awful lot of government support as well. Those two things together are very rare. And that is, we think, what's powering the short-term move in markets. So we're underweight equities. We've actually outperformed since the bottom of the markets. And that's because of the mix of assets we have. So we always think of risk and reward when we're investing. And at the moment, we can get the rewards from the lows without taking the risk of being overweight equities with it.
Okay. Well, let's move on to another asset class then, bonds. You've obviously been talking about active management in the bond market and how you feel it could reap big rewards. Is the opportunity across the whole asset class or in certain subsectors of the market?
So we had a strange situation in March. So the yields on gilts and other government bonds fell. So in the UK, you were being paid 0.7% before the collapse in markets. Today, it's below 0.2%. So you're getting a worse return on your gilt holdings today, way below inflation. You're losing money on government bonds. At the same time, the cost of borrowing for companies went up. So corporate bonds, which are like a loan to a company, yields went from on bond funds from around 2%. You could suddenly get about 6% for what is called investment grade. So these are companies above a triple B or above rating. So the default rates, the risk to your money is very low in that area historically, and you were suddenly being paid the best yields for many years, way above inflation. And we felt that risk reward was more attractive. So we introduced corporate bond funds for the first time in several years. At high yields, so where sub-investment grade bonds live, yields went 8% or higher. So that part of the asset class looks very attractive, but it does come with higher risk, clearly. However, in all of those asset classes at the moment, the implied default rates that the yields suggest are way above what we saw in the global financial crisis in 2008 and previous significant recessions. So we think it still looks a very compelling risk-reward area.
One of the areas that's obviously become, well, it's been a talking point for many years, but it's sort of front and center again, is the value growth argument. Obviously, value's been, as an investing style, heavily maligned in recent years. But at the moment, you're actually somewhat optimistic on that style of investing. Could you maybe tell us why? And is there a catalyst, or is it, just a case of value so cheap it's too good to ignore now?
Yeah. So we have a balance in our portfolios with different styles, but we do think, again, on a risk-reward, value looks quite compelling at the moment. So it's been under pressure because investors have really linked the value growth argument to interest rates. So as government bond yields fall, that is good for growth companies where you're getting maybe a very low yield, but you're hoping for growth over the long term. So if you're being paid 0.2 by gilts, you're probably happy to say, I'll get no income in exchange for a fast-growing tech company or something like that. And with rates falling in March again, this stretched an already sort of tight piece of elastic between the high valuations of growth stocks and the low valuations of value stocks. So right now, it's probably the optimum risk reward for value, but value is a broad church, and typically people think of the very cyclical, economically sensitive companies. So mining, oil, sometimes financial stocks as well. But they sort of require at least the hope of an economic recovery. And that is being questioned at the moment. But the other aspect which helps value typically outperform is inflation. And we are starting to see some inflationary forces for the first time. So the pay rises I mentioned for workers can lead inflation. We've seen the oil price bounce. I think it's up about 43%, something like that, from the lows in March. That will follow through in a year's time or so. You've got the government's procurement of various things at whatever price. There's a whole host of areas where you can see price inflation coming through. There is also things on the other side, obviously. A weak economy, so is not great for pricing power. So it's still in the balance, we would say, but on a risk-reward basis, it looks quite compelling, and most value managers are getting quite excited. The final piece in the jigsaw puzzle is investor position. So the biggest funds in the UK are all quality growth funds at the moment. The Lindsell Trains, the Fundsmiths, and so on. They've been some of the best performers as well. So a number of the value managers simply say they don't need a tailwind, they just need the headwind to abate. And that will allow at least the sort of compounding effect of the cheapness of the value stocks to to help them outperform. And that seems to have started to happen. It was starting to happen at the end of last year. This reaction to COVID-19 stopped that in its tracks, but it started again. And that's why we are outperforming despite being underweight equities.
Obviously, there's been lots of talk about what sort of shape of a recovery we'll see. Will it be U, V, W, etc.? Is your portfolio positioned for a certain type or shape of recovery, or is it simply too early to say?
I think it is a little early, but we have to be positioned. And the beauty of being a multi-manager is obviously we can adapt very easily. We hold 30 or more funds in our portfolios, including the distribution fund we're talking about. There's a balance of styles, as I've said, and we will tweak that as things change. So if we see some more inflationary signs, you'll likely see us lean a little bit more into value, and we will be expecting a sort of a sharper economic recovery, not back to previous levels, but a sharp recovery. So I think that's sort of where we're thinking, but we're achieving that through cheap value managers rather than overweight equities, because there's the flip side is governments control their interest rates at low levels, and we have a low for longer growth environment. That's the sort of flip side of our current view. And we can definitely see that scenario. We just think the balance is tipping the other way.
Obviously, income's a major part of the mandate. Has the sell-off changed your thoughts on the importance of diversifying your income through different asset classes, or has that story sort of already started pre-COVID?
Yeah, so diversification again it's a key aspect of any kind of investing, and obviously it significantly underpins the idea of a multi-manager funds. However, when it comes to a total shutdown of an economy, even defensive areas of the market get hit. So the diversification was almost null and void in March, unfortunately. Added to that, there were some aspects that hit income investors particularly hard. So falling interest rates was not great, as it powered growth versus value, and income typically is a value style of investing. Second, governments forbade banks paying dividends in the UK and in certain cases in Europe. They are putting pressure on insurers, and this provided sort of air cover for companies in other sectors to suspend dividend payments. Now, we are hopeful that many of these payments were simply delays. Companies just wanted to see what happened, and investors will get that money back later in the year. That is the optimistic outlook, and certainly I think will be the case in many companies. But the headline rates in various surveys are for the FTSE 100, 40 to 50% falls in headline dividends. But we should remember there are three big sectors that distort the UK dividend statistics. Banks, no dividends at all. Oil companies, Shell cut its dividend for the first time since the Second World War because of the collapse in the oil price. That's since rebounded. And mining, which was under pressure, but is now looking at a little bit of a renaissance, perhaps. So from here on in, I think dividends outlook gets better, but it's been a painful period. The quarter just gone, our dividends fell by 20% year on year, so much less than, say, the FTSE 100. We would expect that. It certainly should be the case. But it's a challenging time for income.
That's great, Robert. Thank you for joining us today.
My pleasure. Thank you.
And if you'd like to learn more about the BMO Multi-Manager Navigator Distribution Fund, please visit fundcalibre.com. While you're there, remember to subscribe to the Investing on the Go podcast. Please remember, we've been discussing individual stocks to bring investing to life for you. It's not a recommendation to buy or sell. The fund may or may not still hold these stocks at your time of listening.